Most investors see a stock trading at PE ratio of 60 and instantly say too expensive. Then they see another stock with a PE value of 15 and they think cheap bargain. Sounds logical, right? But what if I tell you that PE ratio with 60 stock can be actually be cheaper than PE ratio of 50? This misunderstanding traps investor every year. People avoid wealth creator because they look expensive and they buy weak business because they look cheap. The concept that solves this confusion is PEG ratio. Once you understand it, you will never judge valuation the same way again. Let's start with the problem. P ratio tells you how much investors are willing to pay for earnings. Useful, right? Complete it is not, because P ratio ignores one giant factor, that is growth. A company growing profit at 30% is not the same as company growing at 5%. Yet many people compare both using only PE ratio. That is a lazy analysis. Now enter the PE ratio, PEG ratio. PEG ratio means price to earning divided by earning growth rate. The idea is simple. Valuation should be judged relative to growth. Now let's compare two companies. Company A trades at P of 60 and is growing earning at 40%. PEG became 1.5. Company B trades at PE of 15 and is growing earning at 5% only. Then PEG PEG ratio became 3. Now pause and think. Company B looked cheaper using only PE ratio, but relative to growth, it may actually become more expensive. This is why some high PE stocks deserve premium valuation. The market is paying not only for current earning, but for future earning power. If a company has long runway, strong brand, scalable model, high return on capital, excellent management, and years of growth ahead, investor may willing to pay a higher multiple. Why do some quality retail, consumer platform, manufacturing, or niche leaders trade at premium P for years? Because the market expects store expansion, market share gain, operating leverage, margin improvement, better cash flow, and sustained compounding. That future potential matters. Important warning: PEG ratio is useful but not magic. First risk: growth forecast can be wrong. If the market expects 40% growth and actual growth becomes 10%, valuation can collapse. Second risk: quality of growth matters. Is growth coming from real demand and execution or from temporary cycles? One time gains, tax benefit, acquisition, or aggressive accounting. Third risk: PEG works better in steady growth businesses. It is less useful for cyclical sectors where earnings swing sharply. What should smart investor do? When you see higher P stock, don't reject it instantly. Ask how fast earnings are growing. Can that growth sustain? How large is the opportunity? Is management trustworthy? Is debt under control? Are returns on capital strong? When you see a lower P stock, don't celebrate too early. Ask why growth is weak, why the market is discounting. Is this a mature business with no runway? Is this governance risk? Is this a value trap? That is how serious investor think. Here is the lesson. P tells you price, growth tells you potential. PEG connects both. Cheap looking stocks can be expensive and expensive looking stocks can be attractive. Never ask only what is P. Ask what growth am I getting for the price. That one shift in thinking can stop you from rejecting winners too early and buying traps too confidently. Thank you very much. Make sure you subscribe the channel. Thank you. See you in the next video. Thank you.